Isn't that what on there? Yeah. So hope you guys are practicing, please. Hope you are practicing.
Yes, we are.
Because it will be bad, you know, to attend class. At the end of the day, you will not put in the work, you will not practice. Practice will make it to be perfect.
That is true, Coach.
If you don't practice, you are bound to fail. as far as TA is concerned, if you don't practice TA, 20 years without you being without you practicing it, you will not know anything on TA. So, you know, yesterday we discussed about moving average. Moving average. You know, and I said moving average is a simple technical analysis tool that smooths out price data by creating what? A constantly updated average price. You know, I also showed you guys how to put hope you are seeing my screen.
Yes.
Yes,
I see my screen. Okay.
Yes,
okay.
we can see yourself.
Yes.
So I showed us how to put a moving average or any other technical tool, any other technical indicator, you know, by going through what? By going to indicators, then you type in the indicator that you want to add to your chart. Then it will display moving average. These are moving averages here. And we use 20. The red signifies 20 moving average. The blue is 21. Why the 50 moving average is the one with purple. Please, you can mute yourself. You can mute yourself. Yeah, thank you. So, I gave us the advantages of moving average, you know, which is what? That moving average, moving average helps to cut down the amount of noise on a price chart, you know. That's by what? Giving the direction of the market. It helps you to, you know, to locate the direction of the market, be it in an uptrend position or a downtrend position. So, and moving average also helps to track what? Support and resistance. You know, by if you are going through uptrend, you understand the moving average 50, 100, 200, 20 will be what? Will act as what? As support. That's if you are going uptrend. The moving averages will be acting as support. Why, if you are coming down or if you are going downtrend, the moving average will act as what? Will act as resistance. Just like you can see here that they are all on a what? On a support level. Here is support, here is support, here is support, downwards resistance. You can see that it's pointing downward here. So, and they are on what? On a resistance level. So, then let's go to types of moving average. Now, there are two types of moving average, but if you are placing on charts, they also what? They look alike on charts. They look alike on chart. One is what? Simple moving average. While the other one is exponential moving average. MA and EMA. MA and EMA. That's or SMA, simple moving average. If you don't want to call moving average, you can put a simple moving average, SMA, and exponential moving average, that's EMA. A moving average can be calculated in different ways. The moving average can be calculated in different ways. A 5-day simple moving average, SMA. A 5-day moving average, that's 5 moving average, adds up the 5 most recent daily candle close. Now, one thing with all this indicator is that they are very confusing. You know, when I started using it or going through them, they are kind of confusing because of what? That perception that we have that it lacks so much. So I see more if I base my analysis on price action than using an indicator. So that's the thing. So just put types of what moving average. We have simple moving average and exponential moving average. Moving average lengths. Common moving average lengths are 10, 20, 50, 100, 200. Common moving average lengths are 5, 10, 20, 50, 100, 200. These lengths can be applied to any chart time frame. These lengths can be applied to any chart time frame. In brackets, H1, H4, daily, weekly, etc. Depending on the trader's time horizon, that's depending on the time frame, the trader's time horizon, or the type of trader that you are. If you are a scalper, you know what to do, you know what time frame to use. If you are a swing trader, you know what time frame to use. If you are a position trader, you know what time frame to use. If you are a day trader, you also know the time frame to use. So these lengths can be applied to any chart time frame or to any time frame, be it H1, H4, daily, weekly, depending on the trader's words. Trader's time horizon. The time frames or length you choose for a moving average. The time frame or length you choose for a moving average, also called the look back. That's the look back period. Also called the look back period, can play a big role in how effective it is. The time frame or length you choose for a moving average, also called the look back period, can play a big role in how effective it is. A moving average with a short time frame. A moving average with a short time frame. We react much quicker to price changes than a moving average with a long look back period. That's if you use a moving average on let's say now on H1. You know, if you use moving average on H1, it reacts much quicker to price. It reacts much quicker to price than when you use what? When you use your daily and H4 or weekly. So then the 20 moving average may be an analytical benefit. The 20-day moving average may be of analytical benefit to a shorter time frame traders. So that's why most short-term traders like scalpers and day traders, they normally use the lower moving average, which is what they can, which is 20, 10, you know, because it gives them what? Clear direction much quicker than that of 200 and 100 moving average. The 20-day moving average may be of analytical benefit to a shorter term or short-term trader, since it follows the price more closely. Like if you look at this place now, this is 1 hour time frame. You can see that the 20 moving average or 21 moving average here is following price. It's following price closely. You understand? It's following price closely. Let me hide that of 250. You can see that what on this time frame, which is H1, 20 moving average follows what? Price very closely than what? Than 50. 50 are a bit, 50 and 200 are a bit isolated from what? From this time frame. So the lower the moving average on shorter time frames, you understand, gives you what? As in the effectiveness is more to compare higher time frames, which is daily and weekly. The 20-day may be of analytical benefit to a shorter time trader, since it follows the price more closely and therefore produce less lag time than the longer term moving average. So here now it's since it follows price closely, the time lag, as in the lagging time, won't be that much. It won't be that much because it follows price bomber to bomber. You know, the higher the moving average on higher time frame, the more it lags. So since it follows the price more closely and therefore produces what? Less lag time than the longer term moving average. The longer term moving average are the hundreds, 200. A 100-day moving average may be more beneficial to longer term trader. You see, so if you are a swing trader now, if you are a swing trader, if you are a position trader, you use higher time frame. Use what? You know, these swing traders and position traders, they use higher time frame. You understand? So since they're using higher time frame, it will be good for them to also use what? higher moving average, like the 100, the 200-day moving average. Then the meaning of lag is the time it takes for a moving average to signal a potential reversal. Lag is the time it takes for a moving average, not only moving average, even other indicators, for a moving average to give signal for a potential reversal. When price is moving above a moving average, when price is moving above the moving average, when price is moving above the moving average, the trend is considered up. You can note that. Note it. Note it. Oh. Like on this H1, so when price is moving above a moving average, you can see that this moving average is above here. Look at it here. You can see this one is above. This one is above. When price is moving above the moving average, the trend is considered what? Uptrend. You know, price went up. Price went up above this moving average here. You can see where the buy signal is here. So if I'm to buy now, I will place my buy order just above here, the closure of the other candle. You know, this is a signal. The last candle there is a signal that what? Buyers are in the market. Look at the signal here. This particular one is a signal, but price broke the resistance level, then retested as what? As our higher low. Then boom, price started pumping. Any question so far? Any question? Any question? No question. Okay, I said price, when price is moving above a moving average, just like what happened here. You can see that the trend, this is the what? This is the entry points here. Then you can see that it followed the trend. Look at another entry here. There's another entry here. You know, look at another entry here. Before we now have what? Before price reversed here, and the moving average is what? Below the price. It's now below the price. So when the price drops below the moving average, when the price drops below the moving average, it signals a potential reversal. It signals a potential reversal. So right now you can see that what? Price is no longer above what? The moving average. It's now below. It's now below the moving average. Now this is entry. This place now, this candle is still an entry. This is an entry. Then before now, price started moving sideways here. Price started ranging until we have what? We have a breakout. Look at where breakout occurred. You see? Are you seeing the sideways movement of price? Hello? Hello?
Hi.
Yeah. Are you seeing the sideways movement? Market was trending before it now entered what? Consolidation or moving sideways movement, ranging. Then this was the fake out. You see this place? You see this candle here, this week here, fake out. You understand? So then price broke out from this particular area. Look at the breakout here. You can see the breakout. Breakout occurred, retested, then continued its movement. Are you following? So moving average doesn't what? As in, you can't find entry on what? Ranging market with moving average. It will be flat. It will be flat until a breakout, you know. Of course, so the breakout didn't take much time before price reversed. You can see as soon as the price reversed, the moving average here was above price. Are you following? Before heading what? Below again. As you can see from this angle. Below. Above. So this is how to use what? This is how to use moving average. You use lower moving average on short-term what? Trading. You can still note that. Use lower moving average like 20, 10, 5, you know. You can use them on lower time frame. They give more accuracy on what? Lower time frame than higher time frames. Then if you are a long-term trader, like swing trader, position trader, you look for what? Higher day moving averages. Higher day moving averages. All right. Then we have what we call crosses. Crosses. Okay, let me show you that of higher time frame now. You can see here. Here, there's a buy here. There's a buy here. So if I want to use like H4 now, like H4, I will use a 50 moving average. I will use 50 moving average or 100 on H4. But if I'm on the daily and weekly, I will use 200 moving average. You can see on H4, the 50 moving average price was what? Price was respecting what? Here it closes above, followed above price here. That's above price. Here below price. Here below price also. Price was heading below. Here above. So that's the, if you are using higher time frames, just use the higher moving average. Then there is what we call crosses. Moving average crosses. And sometimes you hear death cross. You hear funny names. If, as in if you are trading, you are hearing funny names. Death cross. Which one is death cross again? So they are moving average crosses. So you can write crossovers on the line. Crossover or moving average crossovers. Crossovers are one of the main moving average strategy. Crossovers are one of the main moving average strategies. The first type is a price crossover, which is when the price crosses above or below a moving average. The first type is a price crossover, which is when price crosses above or below a moving average to signal a potential change in trend. Just like what we have here. If you look at this place, you can see a moving average crossover here. This is a dead cross. Eh? Hello? Hello?
Hello. Yes, we
So
can.
we are with you.
Yes,
Yes,
we are
you.
following. We are following. We are following.
Okay. Okay. So this is the type of cross that we are talking about. You see this one? This signifies change of trend. Yeah. From uptrend to downtrend. This dead cross you are seeing here. Then look at this one. I see this one here. This one is called golden cross. Yeah? This one is golden cross. This one is golden cross. Why this is dead cross? Golden cross is what? The bullish reversal. Eh? Why that is what? Bearish reversal. So let's continue. Another strategy is to apply two moving averages to a chart, just like we have here. We have two moving averages. One longer moving average and one shorter moving average. Just like we have our 21 and 50. 50 is longer, 21 is shorter, right? Now, another strategy is to apply two moving averages to a chart. One longer moving average and one shorter moving average. When the shorter term moving average crosses above the longer term, if you look at this place now, you can see the blue line, the blue moving average, which is what? The 21 moving average, which is the shorter term moving average, crossed above what? Above the purple, which is the 50 moving average. Are you seeing it, guys? Are you seeing it?
Yes, we are.
Yeah. The blue one is above the purple one. The blue one is above the purple one. And it's close, it's very close to what? To a bullish candle. Look at this place. It's very close. It touched what? A bullish candle here. So showing that what? The buyers are in this market. Showing that buyers are in this market. Look at the right. Look at the right from here up. Showing that what? That the buyers are in the market. You can see the trend. Very bullish from here up. So did moving average, did this 21 crossed over here? No. But it gave us what? Signal here. Are you following? So now, when the shorter term moving average crosses above the longer term moving average, which is 21 crossed 50, comma, it gives a buy signal. So when the shorter term moving average crosses above the longer term moving average, it's a buy signal. So if you intend to use moving average, this is what you will look out for. You will look out for all this. You know. So when the shorter term moving average crosses above the longer term moving average, it gives a buy signal, comma, as it indicates that the trend is shifting up. You can see immediately after the crossover, what happened? Uptrend, straight. This is known as golden cross. This is known as a golden cross. So this one now is not a death cross. Death cross is a downward signal. Meanwhile, comma, when the shorter term moving average crosses below the longer term moving average, comma, here our shorter term is below here. Our shorter term is below, while the longer term is above. It's a sell signal. When the shorter term moving average crosses below the longer term moving average, it gives a sell signal, as it indicates that the trend is shifting down. You know, as soon as the shorter term crosses below the longer term, what happened? Immediately a change of trend occur. What happened? Bam. Then you can see here now that the 50 moving average is now what? Is now above. The shorter moving average is now below. This one now is now above. Here, the 21 moving average is above, while the bigger one is below. This one said 21 said, I beg, shift for me. Let me write my trend. Here, the 50 moving average said, Oga, shift for me. I'm in control of this market. Are you following? Are you getting the analogy? Hello.
Yeah, we are getting it.
All right. All right. So when this occurred, you know, you have what? It gives you what? A sell signal, as it indicates what? That is what? A shift. As in the trend is shifting what? Downward. So this is known as a dead cross. So whenever you see this, or whoever that shares the chart with you, and the person is using moving average, when you see it, see this, when you see this crossing, tell that person that look at that the trend is shifting towards to a downtrend movement. Just like here now, if the trend is shifting again, this blue one will cross above. Will cross above immediately. You see a reversal. So one of the disadvantages of moving average is you can write disadvantage of moving average. One major problem is that if the price action becomes choppy, you see, if it becomes choppy, you know, choppy, you can't trade, you can never trade choppy markets. You can never trade choppy market. Even range itself, to use moving average in a ranging market, the moving average will just be moving sideways, following the price, moving sideways. You will not see a direction like this. You can see a clear of trend here, here, and here. So one major problem is that if the price action becomes choppy, the price may swing back and forth. So it will be moving back and forth, generating multiple trend reversal. As it's moving back and forth, it will be generating what? Multiple trend reversals or trade signals. So you can see choppy markets, the trend is always difficult. You can't spot your trends. It will be doing as if buyers are in, sellers are in also. When this occurs, it's best to step aside or utilize another indicator to help clarify the trend. So when you see such market, shopping market, just better you step aside. Better don't trade. I'm in the class, boy. Go away. Don't distract me. So one major problem is that if the price action becomes choppy, the price may swing back and forth, generating multiple trend reversals or trade signals. Full stop. When this occurs, it's best to step aside or utilize what? Another indicator to help clarify the trend. You know, when you are using moving average, you are using indicator. If you, let's say now you are an indicator-based trader, you know, some people are indicator-based. You understand? So when you try this particular one and you didn't see clear as in, the clear direction of the trend, you will now bring another indicator. You bring in another indicator. You know, but you being a price action trader, when you see a choppy market, you will know. When you see a ranging market, you will know. You will know. You know, what happened in a ranging market is that whenever price makes a huge movement, or whenever price moves impulsively, let's say now you are seeing BTC. BTC just made a sharp dump. After making that dump, it will rest. Ranging is kind of rest, you know. It will rest, whereby the sellers will slow down. Then the buyers will step in to see if they can, you know, use that opportunity that the sellers are resting. You understand? Buyers will come in and test the seller's patience to see if they will give up price. You understand? So they will be testing their words, their power. Buyers will test their power. Sellers will, will try and show that, see, I'm in control of this market. You know, they'll be fighting in a range until you see a breakout. You understand? Until you see a breakout. But on a chopping market, or in a chopping market, price will be it will be scattered. If you look at charts, the chart will not be clean. The chart will not be clean. Any questions so far on moving average? Any questions?
Good evening. Hello, good evening.
Good evening, my brother.
Yes, I came in late into the class because I was busy today. I'm very. So I just, maybe there is a kind of summary you can just summarize for me so that I can get the moving average, please.
Summary, but you were in class yesterday, right?
Yes.
Okay. And you made the notes?
Yes.
Okay. So
just the summary.
You didn't understand the crossovers or the 200 moving average? Okay, look at I said, use the moving average. You understand? The lesser the moving average, you understand? Based on the time frame that you put now, scalpers, they make reference to lower time frame. Day traders or intraday traders, they make reference to what? To lower time frame as well. You know, so if you are in this category, you do what? You use lower moving average. You use lower moving average. Sorry, my son is crying. Sorry. So if you are a scalper or a day trader, you use what? You use a lower moving average, like 21 moving average, 10 moving average. They are lower moving averages. So, and the moving average now, price tend to respect what? Moving average by what? If the price is above, or if the moving average is above the price, like we have, let me remove 50 average now. This is 21 moving average. You understand? Let me go to H1 for you to see how it is. Load. So, for example, let's say that we are using H1. You will see that above the price, it will be above price. Look at it here. Look at it there. You can see it. It's above these areas are what? They are our entry points. So now that if the price is I'm trying to share my screen.
Okay.
So now that what price is heading downwards here, you can see that the moving average is now what? Is now below. Is now below here. So then when you have, I also said what? There is what? Moving average crosses. You know, moving average cross. Moving average cross is when you bring what? Two moving average together on a chart. You know, one longer one and one shorter one. What I mean by one longer one is what? Let's say 50 moving average. Now, when I add this 50 moving average here, when I add this 50 moving average, I don't know why my network is just giving me issue. It's not even coming up. Okay, now we have two moving average here. So whenever price, look at what happened here. Look at what happened here. There was a cross here. There was a cross here too. So whenever the loser moving average or the short-term moving average crosses above the longer-term moving average, it gives you what? An indication that there is a change of trend from bearish to bullish. Are you following? There's a change of trend from bearish to bullish. Look at what happened here. You understand? The blue one indicates 21 moving average, while the purple one is 50 moving average, right?
Yes.
Then here, on top here, the 50 moving average crossed above the 21 moving average. So 21 moving average is lower, is below. You understand? While the bigger one, the longer term is above. So when this happens now, it signifies what? A change from bullish to bearish. Isn't it of this thing? You understand? So now when this happened here, he said what? Like it's a golden cross. Are you following? Then when the bearish one occur, he said it's a death cross. Are you following?
Yes.
You say what? It is a death cross. So hope you're okay now.
Yeah, so you were saying something the other time that if the price is trading above the moving average, you were saying due to the network, I was not able to get it.
Okay. That when the lower term moving average or the shorter term moving average is trading.
No, I got that point that once the lower time frame is crossing over the higher time frame is a buy. Then once the higher time frame is crossing lower the bigger time frame is a sell. I understand that perfectly. What I'm trying to say is that you were saying that if the chart is trading above, okay, just like what is happening here, just like what is happening, that the chart is way above the moving average. What does that indicate? And if the below the moving average, what does that indicate? You were saying something about it the other time before the service went off.
Is it this area?
Yes.
This area. Okay. I said I use higher lower term moving average, like this blue one now. You know, they follow price. If you are let's say if you are a day trader or a scalper, you make use of what? The lower or the shorter term moving averages, because they follow price closely. You understand? Just like we have here now. This is H1. Let me remove 50 moving average. You can see that our 50 moving average doesn't follow price closely. You can see price is above what is happening. It's far from price. Then now look at the 21 moving average, which corresponds with this. You understand? Look at how price, price is following closely. The moving average is following price closely. Price is below it, right?
Yes.
So you can see that what? As price is below it, it signifies what? Downtrend movements. If price is above it, is a buy. But if it's below, it's a sell.
Okay. So that means it is safe to say, as a day trader or a scrapper, it is safe to say we should use the lower time frame in our trading activities.
Yes. Yes. You know, day traders, they do the analysis on daily and H4, right? Day traders are those people, are those traders that can hold the trades, let's say, throughout the day.
Yes.
Are you following? Throughout the day. So if I want to be that kind of trader, I will do what? I will start my analysis on the daily first to check how yesterday price closed. Are you following?
Yes, I'm following.
Then I will map out my support and resistance areas. Then I will go to H4 to see if those technical tools that I use align with the daily time frame. You understand? So after checking it, then I will now make my entry on H1.
Okay.
I'll make my entry on H1. I will just wait for 1 hour candle to close to see how the closure will be. You understand? But if I'm in a hurry, if I want to catch that sniper, if I don't want to miss that 1 hour move, I will go to lower time frame and find what? A sniper entry.
Okay.
So that's the thing. So
then what of the yellow line you drew here over the the yellow line, was that the support?
Yes, it was kind of, I was trying to check if it will respect this particular line. Look at a bounce here. So all this area, it respected this area. So there was a breakout. Then price, failed at this point. You know, this is another support and resistance line too. This
Is
area
that your
now,
baby crying, teacher?
my baby? Oh.
It's your baby.
Yeah.
Oh, okay.
So look at another support and resistance area too. You understand? So if you are a swing trader, for example, a swing trader are those that can hold trade for like weeks. You know, they are the mid-term traders. They can hold trade for like weeks. Eh?
Okay.
Maximum, let's say 2 weeks, 4 weeks, you know. You understand? Then if you're that type of trader, you use higher what? You use
Time
longer
frame.
term moving average and what? Higher time frame. The analysis will start from the weekly first. You will look at how the previous week closed. You look at how your daily candle closed. Then you now find entry in H4. You understand? You
Yes.
now find entry.
Please, I have a question.
Yeah.
How do we know how the daily candle closes?
I've said this a couple of times. Like if you look at your daily time now, a day, any candle that you are seeing represent 1 day, right? Just like yesterday closed with a bearish engulfing. Look at it here. Are you seeing it? Yesterday I said the next candle that will pop up is what? It will be a bearish candle. What is happening here? This is a bearish candle, right?
Yeah.
This is a bearish candle. So each of these candles represent daily. You can see today, market is still on. Once is 1 a.m. Nigerian time, another candle will pop up again. You understand?
Yeah.
So that candle that will come up signifies what? A new market, right? A new daily market. That's Sunday. You know, crypto never sleeps. It's 24 hours thing from week to week. But if you visit other traditional markets now, like currency markets, like stock market, they've closed. Once it's Friday, all those ones will go. They will lock their shop, they will lock their stores and go. But crypto never sleeps. Are you following?
Yes.
So that's the thing. If you go to your weekly, one candle represent what? The whole week. It represents what? The whole week. Then if you go to monthly, one candle represent 1 month. You can see this month now, the whole of this candle, this month is totally what? Bearish. Bearish, you know, here. Are you following?
Yes.
Yeah.
That's how to do time frames. H4, 4 hours. Each 4 hours, it will print another candle. Each 4 hours. Then 1 hour, we print one hour, one hourly. Then 30 minutes, we print every 30 minutes. 15 minutes, same. 5 minutes, 3 minutes, 1 minute. So that's how it is. Any question, guys? Any question?
So we can say, because from your analysis now, so it is safe to say both the moving average and the MACD is more or less the same. Hello?
Network is now our friend today.
It's telling us to go and sleep. It's even giving us a chance to discuss. It's a fair network. Eish.
So my brother, I can continue.
Yes, I said from the moving average lecture now, because from what I'm saying, the moving average and the MACD is more or less the same thing.
Yes.
Is it safe to say that?
It's still the same. The MACD is also moving average. Moving average, convergence, divergence. It's still the same thing.
Oh.
If you use simple moving average, exponential moving average, it will still give you the same direction. You will still see the same direction. You will still see that cross. You know? So that's the thing.
Okay, so when the price is now moving above the moving average, what's that? Because from here now, from the yellow line, we can see from the yellow line at the sub-resistant area there.
Yeah.
Is it in a sphere or in a circle?
Around here.
Yes. We can see that the candlestick is way above the moving average.
Yeah.
So if the candle is trading above the moving average, is it good to enter the trade at that point?
Okay, let me tell you now. Thank you for the question. You know, this question brings, I said earlier that low indicators, they lack so much, right? Right? I made that statement earlier. You see this place now, as a price action trader, on seeing this rejection here, you understand? I will know that the sellers are weak.
Okay.
And the sellers can no longer control this market.
Okay.
You understand? On seeing this weak rejection here, I will make what? I will enter my trades immediately. On seeing this first weak rejection, second weak rejection, I will make my entry immediately. But count the distance from here to here. Look at where indicator gave you what? Signal. Are you following? So me being a price action now, a price action trader, entering from here to here, I would have been in profit.
Yes.
Before indicator will give you what? Before indicator will give you a buy signal. You can see that lagging time.
Yes.
So it will take how many hours for indicator to give you signal? 1, 2, 3, 4, 5, 6, almost 6 hours. Because each of these can represent 1 hour.
Yes.
Are you following? Likewise, this area. For me to sell, on seeing these rejections here, I will know that what? Buyers are weak. Then I will now make my entry here before indicator will tell you that sellers are in.
Okay. So that means a price action trader is more preferable. Being a price action trader is more preferable than being an indicator trader.
Yes. Because you are trading based on what you are seeing immediately, what you are seeing happening instantly. Are you following?
So, yes, that means as a price action trader, we must know our candlestick very, very well.
Yes. You will know not only candlesticks. You will bring other technical tools together. You don't use one particular technical tool.
Yeah.
Make your judgment, right?
Yes.
You will bring your support and resistance. You first of all check the direction of the market or the condition of the market. Is the market trending up or is it trending down? Are you following?
Yes.
Then you now use support and resistance to find the key levels, to find that meeting points that buyers and sellers are what? Are in equilibrium points. Right? Then you now bring what? You now check if that area is within a significant zone.
Okay.
You will check if that area is within a significant zone. How many touches did you see around that zone? Is it on a buy zone or is it on a sell zone? You know, a sell zone is always a resistance level, right?
Yeah.
While a
Yes.
buy zone is always at a support.
Yes.
So you will check all these things. Then you now bring what? You now check the chart patterns that you are seeing.
Hello, sir.
Hello?
Please, preferably, how many touches is it advisable to trigger an entry?
How many words?
Touches.
Okay, you can call it bias. You can call it bias, you know. You will bring, I don't really have, I can't tell you how many, but for me, my analysis, I always bring everything together. Except maybe trend line. But on putting my support on identifying my structure, the condition, the support and resistance, you understand? Then the chart patterns that I'm seeing, you know, happening at that particular time. On seeing those things, I will now make judgments whether to buy or to sell. So they must respect, the market must respect all this. Then the candle will now be the last thing. The candle and chart pattern will now be the last thing to give you an entry. You know, when you draw a support and resistance, you've already known that yes, price is at my demand area. It's on the demand level. You understand? You will now wait and see the chart patterns that will form at that demand level. You know, remember that sometimes price will get to demand, it will break that support level and retest, continue heading down to locate another support. Are you following? So once it gets to a support level, what will you do? You will wait first. Be patient and see what will happen there to see if you will see a rejection around that area. You understand? You will see if you find a double bottom around that demand area. Then when you observe it, you now wait for a neckline to break. You know, it will give you what? Must give you sign that sellers are giving up, that buyers are about to enter the market. So that's how to trade. You don't just jump into a market, bam. I don't know, someone told me that that he was buying near. I told him, how can you be buying near that the market is bearish? You understand? You bought near. Instead of you selling near, you bought near. Are you looking at BTC movement or other altcoins movement? You know, you can't trade against the trend. Market will give you kind of bullish bias to confuse you to lose money. But at the end of the day, that buy that you made is a what? Is a pullback, or is a correction, or is a retracement. But the main trend itself is sell, is downtrend. So he was holding that trade. He told me that he was holding that trade. And as well, adding margin. How can you be adding margin to a losing trade? You are adding margin to a losing trade already. As you're adding the margin, in order not to get liquidated, you're adding margin. And market is still dumping. So that's not the best way to trade, my people. That's not the best way to trade. So any question on moving average? Should we go to Fibonacci or should we leave it maybe?
In finding it, please, I want to ask one question. Sometimes in finding entry, maybe you need to be patient for confirmation.
Yes.
Sometimes when you are patient, maybe you just close your laptop and you see that the trade has confirmed. It's already moved in there to your target.
Yes.
Before I will open my phone, it's already moving. I don't know if I should just run and enter the trade. But most times that's what happens. Okay, you already missed that target.
No, you've already missed the target.
Okay.
Your entry point, maybe now you're seeing the trade that the trade is moving according to your plan. You just jump in. Mind you that there's a retracement, right? So, and when you just jump in, before you know it, you will start seeing red. And on seeing that red, your psychology will be messed up.
That's true.
Are you following? Your psychology will be messed up like this. One, fear will come in.
Please, are there any setup or alerts to give you when
yes, there is alert. There is alert on free trading view. You are entitled to one alert here.
Okay, only one.
I used to use this alert very well, so that if I see a particular target area that I'm looking at for entry, let's say now I want to set this support level here, for example.
Yeah.
Let's say now I want to set this support level here, for example. What I will do is that I will come here and set my alert here.
Okay.
You understand? So that whenever price approach this area, it will alert me. I will now look at it.
It rings, eh?
Yes, it will be
okay.
It will give you a sign.
Okay.
You understand? And it will also send alert to your email.
Okay.
You understand? So you now make your what?
Better.
You now make your entry. Or you can as well set what? A buy order. A buy limit order at this point. You understand? A buy limit order at this point. With your stop loss.
Setting a buy order at that support point will be the best option. Seriously.
Yeah. So it's either you set alerts or you set a buy order or a sell order. Like my own now on spot, I have so many orders so that when price get to that place, it will trigger immediately.
All right.
Yeah.
Okay, thank you.
You're welcome. So any question? Should we do Fibonacci or we should leave it for another day?
Please, let us do it.
Oh, let's do it for another day when we're fresh.
Okay.
Fibonacci needs us when we are fresh. It needs us when we are fresh.
So that will be on Monday. So I will take Fibonacci. We'll try and start our class 8 o'clock Nigerian time.
Yes, when we are fresh.
Yeah, so that we will do Fibonacci. Immediately after that Fibonacci, then I will now give you tips.
That would be excellent, because I know we need a lot from Fibonacci.
Yeah.
Yes,
We'll also try and research the little that we can find, so that we'll have lots of questions to learn.
Yes. So,
Coach, sorry, I want to ask.